Hello, everyone. Welcome to our first discussion of 2023. We are going to, we'll call it Celebrate with Austin Fitch as we get started on conversations about what the stock and bond market look like, what consumer price index looks like. I'm Lou Tranquilli, as you know. Thanks so much for joining us. This is our first record and send you a video so that you can make the choice to listen to us. As always, there won't be any charts involved in this, so you can just put us on in the background and do whatever you'd like and listen to Austin and I have a good conversation for the next 35 or 40 minutes about stocks, bonds, and whatever else may pop into our minds at the moment. I have, of course, the usual read. I would ask everyone if you could subscribe to the YouTube channel that you're watching this on. You'll receive these updated videos automatically. You'll get a notification that one has been posted on the Louis Tranquilli YouTube channel. So with that taken care of, let's get to our important disclosure. This webinar, it was created in February of 2023 and is provided by Horizon Investments, LLC and Tranquilli Financial Advisor for educational use only. The opinions expressed herein are as of today's date of the report and are subject to change without notice. Forward-looking statements cannot be guaranteed. This material should not be considered financial advice or an offer to sell any product. Horizon reserves the right to modify its current investment strategies and techniques based on changing market dynamics or client needs. There is no guarantee that their assessments of investments will be accurate. The discussion, outlooks, and viewpoints featured are not intended to be investment advice and do not take into account specific client investment objectives. Before investing, an investor should consider his or her investment goals and risk comfort levels and consult with his or her investment advisor and tax professional. Information has been obtained from sources believed to be reliable, but its accuracy and completeness are not guaranteed. Past performance is no guarantee of future results. Risk assist, which we can have discussion about during this conversation, is not guaranteed against loss or is not a guarantee against loss or declines in the value of your portfolio. It's an investment strategy that supplements a more traditional strategy by periodically investing assets in a portfolio of fixed income securities based on Horizon Investments' view of market conditions. Furthermore, when Risk Assist is deployed, whether partially or entirely to mitigate risk for an account, the account will not be fully invested in its original strategy. And accordingly, during periods of strong market growth, the account may underperform accounts that do not have the Risk Assist feature. While Risk Assist was designed with the goal of limiting drawdown, Horizon is not able to predict all market conditions and ensure that Risk Assist will always limit drawdowns as designed. Accounts with Risk Assist are not fully protected against all loss. Horizon, thank you very much for that disclosure. Austin, thank you very much for that disclosure. Now I will properly introduce Austin Fitch again. For those of you new to watching our videos, Austin has joined us a number of times. He's part of the investment team at Horizon Investments, has worked with Horizon over a decade now. His designation is Chartered Financial Analyst, the highest designation one can receive as an investment advisor to professional financial advisors like myself, to clients. He's the managing director of consulting solutions for Horizon Investments. Austin, as always, thanks for joining us and welcome aboard again.
Absolutely. Thanks for having me. Looking forward to the conversation.
Sure. And let's jump right into it. So today being February 15th, 2023, we had a Valentine's gift yesterday of the Consumer Price Index report. And that report came back with consumer prices only going up 6.4%. 2 years ago, that would have been disastrous. Today, it's a celebration. Please put that into context for us, Austin.
Yeah.
Well, why the celebration?
Yeah, that's a great point, Lou. It's all about perspective. To your point, if somebody had asked us that, at any point, probably in the last 20 years, prior to last year, anything over 2% or maybe 3% would have been seen as a disaster. Coming off a year where we saw, 8, 9% at times in 2022, 6% feels like a godsend in some aspects.
Like a win.
Right. Yeah. So I think you're seeing that from folks. You're seeing some celebration that it does continue to come down. The one thing I would highlight is the fact that CPI, so Consumer Price Index, it is a backward-looking number, right? So it's telling us, in essence, what we've already lived through. We all know that inflation's been high. We know kind of where we were in 2022, where prices really across the board, you name it, food prices, goods prices, wages have gone up. You've seen price hikes really everywhere, it seems like, in your daily life. And because of that, the fact that you're starting to see it come down and it's coming through in the data now, I think that is really the reason that you're getting some of that celebration is, everything that we've been feeling and the heightened inflation that we lived through, and the fact that you're starting to see that cool off a little bit. The data's supporting it, which is a good sign. Now, to your point, we're still at 6.5%, which tells us that we do have a long way still to go. And that's the thing that we're watching for internally here at Horizon is, again, 6.4 is a backward-looking number. We're more interested in what does the next 3, 6, 9, 12 months look like on a go-forward basis. Do we go from 6% back down to that 2% target? And I think our view is we're definitely moving in the right direction, but we're not going to get there overnight. And it's absolutely going to take time before we get back into what the Fed or most economists would consider kind of a normal, stable, long-term range of somewhere around 2%.
Okay, and that is in reading more and more about this and becoming an expert on balloons recently, along with Consumer Price Index, the target for the Fed really is 2%. However, that's a goal. That's not necessarily they're not looking for it all of the time.
Right.
We sometimes have to go through this, what we're dealing with right now. I mean, it's how property becomes more valuable. It's how your used car becomes more valuable. Of course, employees make more money. It is passed along to the consumer. The Fed's tools so far have been to significantly raise short-term interest rates. And also, it seems to me like really just let it play out, raise the rates and then watch. Way back, 2 years or so ago, Scott Ladner of Horizon Investments said it'd be great if the Fed would just raise rates 2.5% all at once, and we just deal with the aftermath of it. A prescient comment, really. But was he a little bit low on that number that he actually thought they should raise it? Because it seems as though it's going to streak past what we all may have predicted.
Yeah, no, and I think the question is, if you had done 2.5%, a year, 18 months ago, would that have been enough at the time? Obviously, we'll never know. But you're absolutely right. We're going to end up with even short-term rates, right? Think of a rate that you can get on a treasury bond that's only, 3 to 6 months. You're going to see those rates probably touch 5%. And again, that's something that we haven't seen in, at this point, over a decade, since before the great financial crisis, right? Before 2008. Which in investment, investment world, that's a lifetime for some people. So the fact is, you're absolutely going to see rates touching levels that we haven't seen in quite some time. The question really becomes is how long do they stay that way? And I think that's really what we're, I would say, kind of wrestling with here at Horizon is, if we get to a 5%, number on short-term interest rates, but it only stays that way for 3 or 6 months. It's probably not as kind of suffocating from a market or an economy perspective as if it stays that way for, a year or two. I think we're probably somewhere in the middle of that range. I think we think that you'll likely get rate cuts by the time you get into early 2024. There's some folks out there that are saying that you may get rate cuts in 2023. I think we're hard pressed to think that you may get them that quickly on the back of them still hiking rates like they are right now. But that's really the question. And I would tell you what the market is also wrestling with is at what point does the Fed start to kind of become what they call a little bit more hawkish or give maybe a tailwind to the economy by lowering interest rates as opposed to this headwind. You touched on it, the idea that, the Fed's tool in their toolbox to slow down inflation is to hike interest rates. And what that in essence is doing is making it more difficult for corporations or businesses or just the economy as a whole to finance those purchases, right? To take out a business loan, to go get a mortgage, to go buy a car with debt. Like those are things that all just incrementally go up as rates rise. So as the Fed continues to do that, what they're in essence doing is dampening down demand, which then kind of has the effect of slowing down that inflation piece. The question is, at what point then do they change gears, flip the script, and start cutting rates to make things maybe a little bit more what they call dovish, where you think of it as supportive of economic activity, making it easier for folks to get financing. And again, our view is that's probably an early 2024 playbook from the Fed. And that's kind of the question is, when does that play out? And that's what like I said, what the market's kind of trying to figure out at this point.
It is trying to figure it out. And if I can just summarize, as I like to do for me as well, because I just boil all that down to a sentence or two. Really what you're saying is the Federal Reserve right now, when we hear they are raising rates, they're hawkish. They're trying to slow things down. Yep. And when they get them slowed down to a pace that they like, they'll become dovish and they'll cut rates.
Yep. Nope, you're absolutely right.
Yep. That's the boiling it down to the basics, but so much goes into that, of course, which leads to the next part of the conversation, short-term bonds, long-term bonds. And it is an interesting conversation. Maybe 18 months ago, we had a conversation that was part of our videos that we send to clients and share with them. And by the way, clients can share with friends, of course. But we had a conversation about the inverted yield curve. Yep. So we are at the inverted yield curve, and just again, that means short 3 to 6 month. Maybe even 1 year length of time, bonds are paying higher rates of return than your 10-year bond. Well, why would you go out and buy a 10-year bond if it's not paying as much as a 6 month? Why would you do that? You're taking on too much risk with the 10-year when you take a lot less in the 6 month and make more money theoretically. So where are we with bonds, which were 2022's pig in the poke, as we would say, but look like they could turn into a bit of the bell of the ball in 2023. Forget parables, just go with the specifics on that. How do bonds look on the horizon?
I think that's a great question. I think if you look at 2022, you're absolutely right. Bonds had their worst year in decades, right? And that came from the fact that rates rose so quickly, and the bond math behind it is as rates go up, prices go down. There's that inverse kind of correlation. The question that we're talking about and that really kind of gets into what you're asking is, if rates start to come down in 2023, or at least even stabilize, do you start to get some outperformance from fixed income that maybe we haven't seen, like you said, in 12 to 18 months? And I think our view is bonds in 2023 likely perform better, I would say easily perform better in many cases than 2022. That's a really low bar. But I think the real potential for outperformance probably is maybe a little bit further out. Maybe it's that 2024 time period, because that's our expectation of really when you start to get the Fed being a little bit more active in terms of cutting rates. Now, that being said, the nice thing about bonds in 2023 that we really haven't had, like we were just talking about, in 15 years, is the fact that you have higher interest rates. So you have rates, even on short-term bonds, that are paying 4%, 5%, 6%. And that's just something that to be able to get that level of yield from a short-dated, even a treasury bond that has little to no, corporate risk or credit risk associated with it, is just something that we haven't had. So if you take that to the next step, then if your corporate bonds, you're even getting a higher yield because you're paying a premium because you don't have the backing of the federal government, for example. So you have you have this yield component that in our view is actually going to add value in 2023 that we really haven't been able to bank on in the last few years, even before you really started to see some of the challenges come around with COVID, with rates as depressed and as low as they were. So I say all that to tell you 2023, we don't think it's going to be a bad year for bonds by any stretch. We think, aggregate bonds could be up 5, 6, 7%, which after a year when they were, down 15 to 20, looks amazing. However, if you think about the tailwind coming with the Fed cutting rates, again, if you think about raising rates pushes bond prices down, cutting rates pushes bond prices up. If you get that in 2024, you maybe even get a little bit more of a tailwind to kick off that year. And that's where we think there's absolutely opportunity from a yield perspective this year, but even from a price appreciation perspective as you get into next.
Sorry, I want to tie the two together. The initial conversation about the consumer price index and the bonds.
Yeah.
So again, boiling it down, I go to the bank and I can earn 4% on my CD. Call it an annual yield on a 6-month CD, and we just talked about the consumer price index up 6.4%. So am I not losing money on that when I make that choice? Isn't that technically a loss? I know it looks really attractive that I can go out and get 4, 5, 6%, but at best, based on your example, I'm matching current inflation, which current inflation was 6.4%. But of course, we've had a much higher number in 2022 for inflation. So just give me the quick on what are we trying to accomplish by owning the bonds? You did bring up price appreciation and again, just boiling it down, that means I bought it at $1 and it goes to $1.10. That's appreciation. We like that kind of appreciation. Yeah. So, so if you can break it down, what are we trying to accomplish by owning the bonds right now?
I think there's a couple things. And one thing, Lou, I would kind of touch on is you're probably doing a little bit better than inflation, right? Because remember that inflation number is going to be backward looking. So assuming you're getting 5 to 6% and inflation over the next 6 months is less than that number, then you've got that kind of working it on your behalf. But to your point, you're not nearly making maybe as much as you think you are with that top line number, which then kind of begs the question, what's the point of bonds? In many cases, that's kind of the ballast or the stability within the portfolio, generally speaking. Now, again, last year, bonds took on a little bit more volatility because of how quickly rates went up. And again, rates going up means bond prices going down. So you didn't have some of that stability, but as rates are either stable or coming down, then you would expect the bonds to be able to offer that stability and in essence, really just churn out that yield in terms of the total return that you're expecting from an investment like a bond in that portfolio, which again, we know that stocks can be relatively volatile. We've seen it for last year. You've seen it to start this year. Now, granted, to start this year, a lot of the volatility has been to the upside. But it's still been volatile. And I think that's the question, or that's the thing to think about with fixed income or bonds is they can offer a reduction of overall volatility within a client's portfolio that from a risk-adjusted return standpoint. So if you think, hey, how much risk am I willing to take to be able to get some level of return, to be able to offset some of that volatility, but still get 4, 5, 6%. Allows for the overall portfolio maybe to be a little bit less, volatile or swing as wildly in terms of the value there.
Okay, and I want to follow that up with a comment question. Okay, Again, no specific advice to any people watching this video.
Yeah,
it allows me though the opportunity to restate there is no one perfect way of investing money. And that is so critically important to call it the theory of Tranquilli Financial Advisor, why Horizon Investments have been on so many of these videos with me, and others that I interviewed for these discussions, because bonds in 2022. Why would I own those? We talked about appreciation. Well, that was depreciation of 15, as much as 15% on bonds. Well, in 2023, it's a completely different conversation. So if you were just to go and say, take the newsworthy advice, you'd have been entirely in technology stocks in 2023, and you would have lost 33%. Yep. So there has to be the realization there is no perfect way. No one out there has it, but exposure to different viewpoints, active management, passive management, bonds, stocks, maybe a few alternatives in there. All of it makes sense. It's just that it makes sense at a different time. And that's really what I was getting at. This time isn't different. If you've heard me say this before, it's just a different time. That's all. So it just gave me the opportunity to restate maybe the obvious of how we look at it, Austin, but this is our job. People that are watching this video, that are sharing this video, they may not look at it every day that way. They may read and think, oh, I should be over here. Well, we should be in a lot of different places with that down. And that leads to the very hot start to stocks in 2023. All the things you just explained, why is the stock market going up? Explain, please.
You've gotten this bounce to start the year. And it's been interesting to say the least. It's almost as if you had pulled on this rubber band so far in 2022. Lou, you talked about some of your high growth kind of technology type stocks being down in some cases 40, 50, 60% in 2022. And it's almost like you had this realization that, okay, maybe we went a little bit too far in 2022, because honestly, and we were looking at this just the other day, almost everything that has outperformed in 2023 were your underperformers in 2022, and vice versa. Anything that, there were a handful of segments of even the stock market last year that were, less negative or even marginally positive, right? Single digits, nothing, hit it out of the park. But those are the areas, they had a really strong relative 2022, but this year they're lagging, those high growth, high flyer names that have, that are up 15 to 20% in the first 6 weeks. So you've had this reversion play where, again, it's almost this realization that maybe things got a little bit out of bounds last year on both sides. Things maybe weren't as good for those super value oriented defensive stocks as the market would have suggested. They weren't as bad for some of those, high flyer growth names as the market would have suggested. And you've seen this reversion. Now, our view is that probably works itself out over the next 6, 8, 12 weeks, because our view is the first half of 2023 really isn't one where there's like an abundance of clarity. We don't think that, the calendar didn't turn over and somebody, a light bulb came on and we all realized that, Facebook or Meta or, whatever they're called now, Google, Amazon, they didn't realize how to make money after forgetting how to make money last year. It's just you've had this flip of people realizing maybe we got a little bit offsides last year, and you've seen that correct itself. Our view for the rest of the year is this idea that you probably get this coming back to earth period over the next little bit. And then really the back half of 2023 is probably where you would expect to see a little bit more of like what we would call kind of sustainable strength. And that's a market where maybe there's opportunity or a trend that really starts to form, and a market that maybe doesn't chop around and just go sideways for another 6 months, but maybe actually starts to go higher again, as opposed to, some of the volatility that we've seen for, 13, 14 months now.
All right. Excellent. And I appreciate that forward-looking statement. Probability of recession.
It's funny you ask. So if you had asked this question, and we probably did, I'm sure we talked about it last summer, the probability of a recession over the next 12 months was almost 100%. And we can get into a conversation about whether we were in a recession last year or not. But what's super interesting now is the probability of a recession is, in our view, less than 50.
Excellent. Okay. Well, less than 50. You answered. Yeah, that's great.
I was going to say, the question is, obviously, given what we know today, that's our view. But I bring up last year because that tells you that it's gotten markedly better in terms of the economy understanding kind of the direction of the Fed and what that impact's going to be. And our view is that so far, they've done a halfway decent job of kind of walking that tightrope to continue to raise rates to slow down inflation without blowing anything up from a growth perspective. Now, who's to say that they, still can't do it and still can't, throw the stick of dynamite in there and everybody take cover. But what we've seen so far puts us in a halfway decent spot.
Okay. And again, thanks for that probability of success of under 50% for recession. And I do and did get your reference to balloons bursting again by saying blowing things up. So
there you go.
Sorry, I can't get off of that because everyone has become a balloon expert, myself included. With weeks ago, I didn't know these things were flying around. So it's just it adds a little, I'll say a little bit of interest outside of just investing here. So you've been clear in covering these different parts of the market, market meaning stocks and bonds, and then of course the Federal Reserve and their actions, that there isn't a lot of clarity. So in the approach, and we'll make it a sweeping analogy. Okay, we'll go with that right now. Ownership of stocks to bonds to cash, and let me just qualify it with no specific advice here. Just generally, how are you approaching risk right now at Horizon of the amount of or percentage? I'm sorry, that we own in stock, or that you look at and say this is a good enough percentage in stocks. It's nice to have this amount in bonds, and maybe some cash over here for the use of buying some of the dips here, if we see it.
Yeah. Now, and I think one thing I would kind of caveat this with is obviously this is, and I think you're kind of getting at this as well. Obviously, it's dependent on the individual client, right? A client that's got 40 years to spend invested, we would almost always say, hey, take as much risk from a stock bond perspective as you're willing to accept. Cash probably isn't necessarily an asset class that should be considered by somebody that has a lot of time. That being said, the client that's more focused on, preserving or protecting assets, where cash does start to at least be a consideration from an asset class perspective. Again, I would go back into 2022 just to set the picture. Last year, there were times when we were, depending on the underlying strategy, we talked a little bit about kind of risk assist there in the disclosure. Depending on that underlying strategy, we were anywhere from 60 to 80% cash with some of the volatility that we lived through last year. So that hopefully sets a frame for where we're coming from. I would tell you right now, depending on the portfolio, you're probably in the 20 to 10 to 30 range. So it's definitely come down. We still think that there's as we were talking about, some of that uncertainty absolutely still exists. So I think that's something to bear in mind and keep kind of in the back of your mind, that there's still some uncertainty in the market, but it's gotten markedly better from where we were 6 months ago. And our view is that it probably continues that way. I think collectively, again, assuming nothing dramatically changes with the economic picture, that you're not, nothing unforeseen at this point comes into focus. We could see that number being back down close to zero by the time we, easily get into the summer months. So that's the cash piece. I would tell you the stock bond mix. I would say this, to what we talked about earlier, the bond component is a lot more attractive than it was last year. But that still doesn't mean that you should necessarily be overweight bonds. I think our view there is there's a lot of potential growth opportunity, especially in the back half of the year from a stock market standpoint. So just balancing the stock and bond mix based on the level of kind of risk or volatility you're willing to accept as you normally would is probably where you want to be between those two asset classes.
Okay. And because I do so much reading and I reference back to it in my mind as we go through these conversations. In 2022, there were multiple articles I read. Is the 60-40, 60% stock, 40% bond portfolio, is it dead? Well, here we get to 2023. We're 6 weeks into it, and all of a sudden, it's back to life kind of thing. So be willing is what it is the theme of today, which is be willing to look in different areas that we are suggesting and different theories. And that's, again, what part of the reason that we've had such a long-term relationship, Horizon Investments, Tranquilli Financial Advisors, the fact that Horizon, you're willing to reassess. You understand that we don't necessarily use only Horizon Investments at Tranquilli Financial Advisor, that we're combining different theories. And this is why you are explaining why in all of these different factors, because you have the Horizon view, others have their own view. No one is perfect at this. It's really, I keep going back to it today, but simply because we've had a really great viewpoint of it over the last 14 months plus of how volatile this can be and how we need to prepare for each one of those pieces of volatility. And we've done so, which I'm of course proud and happy for everyone that we talk with about that. So with that, we're just over a half an hour of conversation here, and I promise we keep it about 35 minutes. If there was something that I didn't touch on that you're speaking about at Horizon Investments, can you share it with us right now? Is there something that we should at least mention as part of this conversation? Maybe something looking forward?
Yeah, I mean, I know we've touched on a lot of it. I think the thing that I would say is, for the first time probably in 2023, you may actually see international markets become attractive again from a stock positioning standpoint. And that's because a lot of different reasons are in play. We think the Russia-Ukraine war probably resolves itself at some point during the year. You've seen in China specifically, coming out of lockdown over the last couple months at this point. Not necessarily that means you should, go invest in China directly, but the second derivative of that is a pretty big deal for the global consumer, right? It opens up manufacturing that's been, in essence, shut down in a lot of cases for the last couple of years. So in theory, that should make prices a little bit more attractive. It obviously gives you a whole extra billion plus people that are consuming again at a higher level, right? And the thing that we've done is look, remember where we were, I guess it was January of 2021, right? We had been, I won't even say we were in lockdown, but we were coming through 2020 with some pretty strict COVID policy, even in the US. Right. At that time, January of 2021, the US and China were roughly at around the same level of COVID policy in terms of kind of shutdown, if you don't think of it that way, economic activity. Obviously, we know how the US policy changed and where we stand today. Think of it, though, as China has maintained that level of policy strictness since then, over the last 2 years. So the question is, if they start to ease their policy there, is there kind of a boost or a boon to global economic activity like we saw in the U.S. in 2021? Again, not something that plays out overnight, not something that all gets captured in the first quarter. But what our view is, the global economy does probably have that tailwind, especially as you get into the back half of the year, because of some of these kind of forces that are changing and moving to some extent behind the scenes or politically that aren't directly tied to the market per se, but coming from policy in a lot of cases.
Okay. And I think the term that you're referencing is revenge spending. The U.S. was a revenge spender in 2022. And now the possibility is that 1 billion plus people in China who've experienced an extended lockdown will go out and revenge spend, pushing forward a lot of the economy in Asia and Europe. So Austin, before we go, I just want to mention it to everyone again. Please subscribe to the YouTube channel for Louis Tranquilli, and you'll get these recordings. You'll get a notification. They've been posted automatically. I want to thank you again for your time. We'll do it again at least one more time in 2023, I would assume. And I'd say probably more like 2 or 3 more times if you'll join us. So thanks again, Austin. Always a pleasure.
Really appreciate it, Lou. Thanks for having me.
You bet.
All righty.
Thank you, everyone, for taking the time to watch our conversation or listen to our conversation with Horizon Investments. Of course, we have our compliance requirement, and I'm glad to share that with you now. This webinar was created in 2023 and is provided by Horizon Investments, LLC, and Tranquilli Financial, LLC, for educational use only. The opinions expressed herein are as of the date of the report and are subject to change without notice. Forward-looking statements cannot be guaranteed. This material should not be considered financial advice or an offer to sell any product. Horizon Investments and Tranquilli Financial Advisor reserve the right to modify our current investment strategies and techniques based on changing market dynamics or client needs. There is no guarantee that our assessments of investments will be accurate. The discussion, outlooks, and viewpoints featured are not intended to be investment advice and do not take into account specific client investment objectives. Before investing, an investor should consider his or her investment goals and risk comfort levels and consult with his or her investment advisor and tax professional. Information has been obtained from sources believed to be reliable, but its accuracy and completeness are not guaranteed. Past performance is no guarantee of future results. Risk assist is not a guarantee against loss or declines in the value of a portfolio. It's an investment strategy that supplements a more traditional strategy by periodically investing assets in a portfolio of fixed income securities based on Horizon Investments' view of market conditions. Furthermore, when risk assist is deployed, whether partially or entirely, to mitigate risk for an account, the account will not be fully invested in its original strategy, and accordingly, during periods of strong market growth, the account may underperform accounts that do not have risk assist feature. While Risk Assist was designed with the goal of limiting drawdown or loss, Horizon is not able to protect and predict all market conditions and ensure that Risk Assist will always limit drawdown as designed. Accounts with Risk Assist are not fully protected against all loss. Thank you so much for watching and taking a moment to listen to this compliance read. I will speak with you again next time.